Hey guys, my name is Brett. Thanks for joining my channel where we talk about money, what to do with it, and how to make more. First, I'm going to go over a couple things to consider to see if a refinance is best for you. Second, I'll go over the steps that you should take to make sure that you get the best terms and the best service. In response to the Rona, banks have made some adjustments which are making it a little bit difficult for people to buy a house and also a little bit harder to refinance. Larger banks like JP Morgan and Wells Fargo are requiring higher down payments and higher credit scores in order to buy a house. As far as a refinance go, the numbers haven't changed a lot from a refinance standpoint, but they have upped some of their documentation requirements to ensure that you are not negatively impacted by the Rona in a way that would prevent you from paying your new mortgage. For example, they now want bank statements within the last 60 days. Prior to the Rona, it was 120 days. They're also doing employment checks 3 days before the close of the refinance to ensure that you still work there. But even with all this, rates are still at all-time lows, lowest in history, greatest rates ever, huge low rates. They said they couldn't be, but they are. Seriously, think of the most deadbeat, low-life person you know. Rates are lower than that. Rates are lower than your savings account balance. Rates are lower than my IQ. And some of you didn't think that was possible. Rates are... You get the idea. Rates are low, all-time low. As I talked about in my video back in March where I made $40K over 18 months with our first home purchase and then refinanced out of PMI, the Fed slashed the interest rate by 1.5%, which can have an effect on mortgage rates. That's part of the reason we're seeing some of the lowest rates ever. One of the most important things about refinancing is understanding your loan to value or your LTV. How much is your house worth versus how much do you owe on your house, your loan to the value. I've been resistant up to this point to accept that housing prices were going to dip. The reason is because as a millennial, the only recession I've ever experienced was the one as an adult was the housing bubble. And so I feel like we give too much weight to housing going forward, and we're expecting housing to crash, even though that's not typical in a recession. If you look over the scope of the last 200 years, it's pretty unique to 2008. So all that to say, I've been fighting it. I didn't think real estate prices were going to dip, but now I do. But what does that have to do with refinancing? The CARES Act, aka the stimulus bill with the Daddy Trump dollars included in it that paid most of us Americans, also provided provisions preventing from banks for foreclosing on mortgages that haven't been paid and landlords from evicting their tenants. But that's not going to last forever. The banks still have to prop up those loans. They still have those loans even if they're not being paid by the people who they've lent them to. That's causing banks to act more conservatively, which is why they're raising their lending standards. They're raising their standards to attract more qualified buyers, but the result is it makes it more difficult for everyday people to buy. The more difficult it is for people to buy, the less buyers you'll have. The less buyers, the less demand, the less you have to sell your property for in order to get someone to buy it. So I do think the prices are going to decline. I think there's going to be a flood of people who are trying to sell their homes who are negatively impacted. Probably in the fall. I believe the CARES Act offers protection through September, so I think right around the fall you're going to start to see a lot of real estate come onto the market of people who've been negatively impacted and can't afford it, if it's not already put on right now. But what do I know? I'm an idiot. Why does that matter when we're talking about refinancing? Well, it's better to refinance when your house is worth more because that will give you a more favorable loan to value ratio. The higher your value is, the better your loan to value ratio is. Again, loan to value is how much money you owe versus the value of the home itself. The more value that you have, the less riskier you are for banks, and so they're more willing to lend to you and they're more willing to give you the best rates available. But loan to value is even more important because if you can get your loan to value below 80%, then you can get out of PMI, which is property mortgage insurance. And if you've seen any of my other videos, you know that I hate PMI because it is essentially wasted money. So with all this said, should you refinance? Hey, I'm glad you asked. The answer is probably yes. How do you do that? Step one, you want to qualify yourself. Go to a website like NerdWallet or Bankrate, put in your property details, your zip code, and they will give you an idea of what banks or lenders are going to give you. What rate, how much it'll cost, what your new payment will be. If you live out in the boonies, you might have one, you might have none. If you're having trouble finding any lenders with your zip code, just try changing your zip code to a more popular area. Again, this is just for research purposes. You're just out there trying to see what's available to you based on your credit, based on your loan to value. It's just the research phase. You're just exploring. Kind of like insecure frat daddies who date a lot. Not committing, just exploring. What is that?
I don't know.
What we're trying to figure out is with your property value, your loan amount, your credit score, are you able to get a loan that is better than your current one? So that's why we're working on these websites. We're doing a little bit of research. If your credit score is garbage, you might not be able to get a better loan. So you're done. Don't refinance. Keep your loan, sell your underwear on the internet, pay off your mortgage faster, live long and prosper. I was talking to a buddy last week. He can go from 5.25% down to 3.5%. Done deal. Sign the paper. Save him $200 a month. Boom, baby. So after you've qualified yourself to figure out if you can get a better rate, it's time for step number 2. Get a couple soft quotes from some lenders. Be sure to shop around. You want to look at more than one. Lenders have different loan origination fees, and some people are even offering lender credits to try and win your business. You can choose one of the lenders that you find on one of the websites that I just listed. You can choose a friend. You can choose a local bank or credit union. Pick whoever's got the best terms. Reach out to a couple of them, compare and contrast, and pick what's best for you. Don't fill out an application until you know you're going to go with them. Every mortgage broker who is worth anything can give you an estimated payment, estimated rate, and an estimated savings over your current loan, and they can do that over the phone in like 5 minutes. You can even email them or text them. Sometimes I feel like we approach the bank or the lender and we say, please daddy, what will you give me? But at the end of the day, they're only doing business with you because they think they can make money off of you. So they should have to earn your business. Stop. Listen, if you're still here, like the video. Quit being selfish. Get an ounce of discipline, take your fat little thumb, and jackhammer that like button until it turns blue. Stupid fat hobbitses! Okay, alright, we got it. Step number 3, Jeffrey Epstein didn't kill himself. Step number 4, get rid of PMI if you can. As I mentioned before, PMI, property mortgage insurance, essentially wasted money. If you can get your loan to value ratio below 80%, you can get rid of PMI. So even if the rate is the same or it's really close, it may still be worth refinancing just to get rid of PMI. I don't want you to try your best. I want you to do better than your best to get rid of PMI. Overestimate the value of your house and pray that the appraiser's having a good day when he comes out to visit. The higher the value of the house, the lower your loan to value. You can also talk to a broker about an 80-10-10 loan. This is where you finance 80% of your loan on a primary mortgage, and then the remaining amount, usually 10%, is financed on a second mortgage, which is typically a HELOC, a home equity line of credit. You can talk to your broker about this. Sometimes it pays off to do the 80-10 split. To avoid PMI, it may be cheaper to pay 2 separate loans. Typically, the second loan has a higher interest rate, so you're gonna have to do a little math. Just ask your broker about it. They should be able to do it and let you know whether or not it's a smart move. People do this when the cost of PMI is more expensive than the higher interest rate on the HELOC. So if you can do that, do it. Pay the HELOC off early and you're a baller for life. Step 5, fill out the application and be on your merry way. Rates are highly volatile right now. They are literally changing every single day, going up, going down. It can literally change from 3.125 to 3.375 depending on what time of the day you lock in your application. Ask your broker, the one that you chose, what's the best rate they've seen in the last 3 weeks for someone in your shoes, and then tell them you want that rate. Say, hold on, I'm going to get my application in, we're going to get all my stuff squared away, you're going to approve me, but we're going to sit tight and wait for the rate that I want before I lock it in. You might have to wait a day, a week, couple weeks, but ultimately if you can save an eighth of a point because you waited a week, it's going to save you 10 grand over the life of the loan. So it's worth it to be patient. That's it. You're rich. Did you know that for every person who jackhammers the like button blue, one less husband is killed by Carol Baskins? Do it for Joe. Drop a comment below. Let me know what you spent your Trump bucks on. Thanks, guys.